All right. Today is Wednesday, September 15th. This is a recap for the stock market activities today. Folks, we're about to enter a couple of days here where the fundamentals and the technicals will not matter at all. So what will matter? Number one, the seasonality. Number two, the mechanics of the market. What do I mean by the seasonality? Well, today is Yom Kippur. Now, we know, historically speaking, that pretty much every time we have Yom Kippur, the market pumps higher. Sell Rosh Hashanah, buy Yom Kippur. For example, back in 2017, similar story. Yom Kippur, we have a pump. 2018, Yom Kippur, we have a pump. 2019, another pump. 2020, here we go again, another pump on Yom Kippur. Will 2021 be an exception? Of course not. Today's Yom Kippur, and we have a bounce and a pump in the market. These have been reliable patterns that pretty much most traders know about. But we have fortune tellers, the likes of Tom Lee, for example, who prey on the naivete of certain traders. Let's say if I go back to the 15th century, but somehow I still have access to Wikipedia, and I tell the dummies over there that I'm God. I demand that they give me all their money and their women. What do you think will happen? They'll lock me up in jail. But then I will say, you know what? On September 15th, of this year, meaning 2 days from now, I'm going to show you guys a miracle, a sign of my anger. The sun will go dark midday, a solar eclipse, and that's a sign that I'm God. And what do you know? The solar eclipse happens, and these people release you from jail. They give you all their money, all their women, and they start worshiping you as God. And this is exactly what Tom Lee is doing. Of course, the difference is he's playing the dummies in the 21st century when we have access to all kind of information. But back to the seasonality. Why do we buy Yom Kippur? What's going on here? Is there some historical reference? Is there something we have to keep in mind? Well, here it says, the historical origin is based on the concept that followers of the Jewish faith want to be free from material possessions during the most sacred period of the calendar year. During the 10 days between the two major holidays, Jews reflect on their actions from the previous year and atone for their sins, while setting new agenda for the upcoming year. Upon completion of the cleansing process, they're free to return to the market and evaluate investments for the upcoming year. Those who are ultra-religious may abstain from the markets altogether during this time. So apparently our Jewish friends took the time off, dumped a bunch of stocks, because that's material positions. You don't want that. And they took the time to reflect and look back, think about, consider. And after the holiday is over, they're going to say, let's buy stocks again, because Papa Jerome is behind us. Now, here's the problem though. We have the historical pattern of the Yom Kippur pump, but we have a problem here because Friday we also have quad witching, which will complicate things here. Quad witching, options expirations, and on top of that, historically speaking, when we talk about seasonality, after September 17th, all the way till the end of October is perhaps the worst season for the stock market. So yes, we got the Yom Kippur pump, which usually lasts for a few days, by the way, not Yom Kippur, but the pump. But we know that Friday's quad witching, and oh, by the way, next week is perhaps the worst season, the worst week in stock market history when we talk about the seasonalities. Now, let's talk about the mechanics. What do I mean by the mechanics? Perhaps the mechanics are the key to solve the seasonality mystery, because you have one bullish catalyst in Yom Kippur, but you have one not so bullish catalyst in quad witching, lots of volatility in quad witching. And then we have one for sure to be a bearish catalyst, which is the aftermath of September 17th, going all the way to the end of October. The mechanics refers to the algos and the positioning when it comes to options, which I will share with you for the three most important stocks in the market: Apple, Tesla, and the SPY. Because when we talk about the market's action today, in the morning we got a gap higher. But the gap was sold off, sell the rip. That was expected. But today we saw the return of buy the dip. But was buying the dip done by human beings, traders, or done by the algos? The answer is the algos, because you see the slow grind higher on low volume, pretty much no resistance at all. The selling is already done, it's over, and now we have an algorithmic program buying the stock market, buying the indices, pushing everything higher, the tide that lifted all boats. The problem is the human being will be involved sooner or later because we have quad witching. So when you ask me, is this the return of buy the dip? Is the correction over? Or is this a dead cat bounce? The key to answering this question is unlocking the mystery of seasonality and the mechanics of the market. This is what we will try to do in this program. Of course, the fundamentals matter in the long term. We have some indicators that we got in the morning today, from the Empire State Index to the Import Price Index, and we will go over all of these in the headlines of the day video. But for now, I'm moving on to the market's coverage today. And here we go. The Dow Industrial Average closing in the green by 236.82 points, or a gain of 0.68%. The Nasdaq closing in the green by 123.77 points, or a gain of 0.82%. The S&P 500 also closing in the green by 37.65 points, or a gain of 0.85%. What about the sector's performance today? Impressive. The tide that lifted all boats, the algorithmic program, at number one, capturing the gold medal, energy, by far a massive day for energy. The number two for the bronze, number two for the silver, materials, and a number three for the bronze, industrials. No theme whatsoever here. Obviously, the leadership of the market came from the inflationary side of the market, aka my favorite stocks, the maverick kind of stocks. We're talking about Alcoa, we're talking about oil, we're talking about steel, copper, fertilizers, that kind of stuff. But in the mix, tech, growth, momentum all outperformed today. Perhaps the defensive sector of the market, utilities, underperformed. You see the defensives, utilities, defensives, and REITs all underperforming for the day. So it's an offensive day. Lots of optimism, not from the human being, but from the algos. What about the advance to decline ratio? Yesterday, the ratio was awful across the board, and we said that this is a sign for a market bottom. And indeed, we have the bottom today. We have a lot of improvement here in the advance to decline ratio for the NYSE, 71% advancing versus 27% declining. Meanwhile, the Nasdaq, 62% advancing versus 35% declining. Moving on to futures, massive day for commodities, green across the board with minimal exceptions here. The story of the day was the energy market. Crude oil skyrocketing higher to the moon. Massive gains of over 3% for the WTI and over 2.5% for crude oil Brent. But the story remains natural gas. Another day, more gains for nat gas, gasoline prices rising higher, heating oil prices rising higher. Oh, and by the way, you don't see it on the screen, but propane gas prices also going higher. What about softs? Gains across the board. Cocoa, OJ, coffee, lumber, sugar, all rising higher. The exception is cotton futures slightly negative. What about metals? Modest downside here for gold, silver, and platinum. Meanwhile, a rebound for palladium futures, while Dr. Copper continues to rise higher. What about meats? Rebound day for lean hogs futures. Meanwhile, losses for feeder cattle futures, while live cattle futures closing at the flat line. What about grains? Gains across the board here. Canola, oats, rough rice, wheat, corn, soybean oil, soybeans futures, all trading higher. Massive gains for oats futures, almost 5% in the green. The only loser here is soybean meal futures, closing in the downside, be it modestly. Moving on to the big casino, the options market. What's going on here? The hottest table in the casino remains Apple, with about 1.3 million contracts traded today. About 66% of those were calls. The number two, Tesla, the souffle, with about 760,000 contracts. About 51% of those were calls. And number three, AMC, with about 565,000 contracts. About 71% of those were calls. We have support.com. I believe this is over now. Support.com merged with the Bitcoin miner, and it's not tradable anymore. But let's go over the options grid for Apple, Tesla, and the SPY. Because when we talk about positioning and the mechanics of the market ahead of quad witching, we have to know what traders are thinking about. What is the sentiment leading to that day? So when we start with Apple, for example, here are the calls. And as you can see, massive volume traded for the name today. These are the expiration date for this upcoming Friday, by the way. And I'm looking at the 150 calls. Massive volume and massive open interest. Now, I place more weighting on open interest than volume, because volume can be misleading. All what it tells you, the volume that is how many trades took place today for that particular strike price. So for example, when we look at the 150, we had about 112,000 contracts exchanging hands between selling and buying, perhaps multiple times, intra-day type of trading. But sometimes the volume is important to understand whether the open interest is increasing or decreasing. For example, the volume is way higher than the open interest for the 147 all the way to the 149 call strikes, which means we've seen a lot of closing of these positions. The 147, 148, even 149 calls. But what's being opened here? The 150 and beyond. They're buying the 150 calls. They're buying the 155 calls, all the way to the 160. So the sentiment says Apple goes higher. This is what they're predicting and betting on. There are no guarantees that this will happen. Now we contrast this with the puts, and let's see what's going on here. Right away, you notice that we have the 150 puts with about 87,000 contracts open interest. Now remember, we had about 177,000 contracts in open interest for the 150 calls. So who has the upper hand here? Call buyers or put buyers? The answer is call buyers. Or we're seeing traders closing the 149, 148, 147 puts. They're still not closing the 150 and above, but if the stock starts to trade higher based on the overwhelming buying of calls, you will see these puts getting closed immediately, booking profits, whatever left in there. Again, this is the assumption, no guarantees that this scenario will happen. Yet it shows us the positioning and the sentiment among market traders. Specifically for Apple, they're betting that perhaps we have reached the bottom and the stock should trade higher from this point on. When we look at Tesla, for example, the most important number is 750. Now the stock is trading slightly above 750, but they have been buying millions and millions of dollars of the 750 calls in the beginning of the week. The Monday, Tuesday pump. And so far, we've been seeing profit taking in that trade, but it remains the highest open interest heading into quad witching Friday, with about 20,000 contracts on the line. The stock is now in the money, so these traders will have to make a decision starting tomorrow. Do you want to buy the stock at 750, knowing that September 17th and beyond is a horrible season for the market? Or are you going to book profits? You're already trading above 750, you're already in the money, and you're going to start booking profits. On the other side of the trade, the market maker who sold you the call options, where they're going to be obligated to buy the stock and deliver it for you at the market price on Friday. So is it in their interest to let the stock rally beyond 750? Probably not. And whoever been pumping Tesla has no interest at all in owning the stock. Now, let's contrast this with the puts. What's going on here? And I'm looking at the 750 because this is the inflection point in the stock. The highest open interest remains at 740 with about 10,000 contracts, much less than the 750 calls for the same expiration date. So again, positioning wise, the bulls have the advantage and the sentiment is bullish. The stock to rise higher, but it depends on the market makers here and those involved in these trades. We have seen lots of closing here, at least today for the 750, 740, as if the bears waving the flag saying, you know what, the stock is not going to drop here, let's close this one and move on. So what is the risk versus reward when it comes to the market maker? If the stock trades below 740, what are your obligations as a market maker? Your obligations are, you're going to have to buy the stock at 740. Meanwhile, the obligations for the buyer is to short the stock at 740. So what is the sweet spot to park the stock here? The answer is 745. Because that's where the maximum pain is. All of these 750 calls will expire worthless, and all of those 740 puts will also expire worthless. Now, what is the max pain point for Apple, given the information that I just shared with you? Well, you certainly don't want the stock to close below 150, because now you're obligated to short the stock as a market maker. You don't want to short Apple. On the same token, you don't want the stock to close way above 150 because this will cause you to lose a lot of money delivering those shares when they get exercised. Let's say Apple closes at 153, 155. That difference between 150 and 155, these are losses for you as a market maker. So the sweet spot here is to park Apple at 150 and 50 cents. 151, and that's about it. That will make the 150 puts expire worthless, and it will make the 150 calls expire in the money, but the delivery of these shares, no problem at all for the market maker. Now, what about the SPY, the market in general? What's going on here? And these, once again, for the expiration date of this upcoming Friday, September 17th. The highest open interest is out of the money at the 450 calls with about 180,000 contracts open right now, which means that the interest for the market maker is to close the SPY below 450, and therefore they're not going to have any obligations when these options are exercised. Now, on the other hand of the trade, the buyers of these 450 calls, are they interested in exercising these options and buying the SPY? Perhaps, but knowing the seasonality, that September 17th and beyond all the way to the end of October, a bad season for the stock market, the reality is a lot of traders don't want to exercise these options. They're trading them, and as the SPY marches higher, closer to 450, they're going to close these contracts, booking profits. Now, when we look at puts, the highest open interest is in the money, the 450 put. What is the obligation for the buyer of these puts? They're going to have to short the SPY at 450. We are still in a bull market, in a hypermania bubble market, where the risk is to the upside. Who in their right mind will start shorting the SPY at 450 right now? So the assumption is the buyers of these options are not interested in carrying them all the way till expiration date. On the other hand of the trade, we have the market maker, the seller of these puts. What is the obligation of the seller of the put? Your obligation is to buy the stock at that price. Is the market maker going to buy the SPY at 450 when it's trading down at 447, perhaps 445? No, they're going to lose money here. And therefore, their interest is to push the SPY higher, but not above 450. And this is what we're seeing right now. So again, the seasonality combined with the mechanics and positioning, and you can see that the interest for market makers is to park the market and certain stocks at certain levels. Meaning, yes, we have expectations of volatility, but in reality, when it comes to quad witching, the market maker wants to park the market at the maximum pain point. And in the case of the SPY, it's 450. In the case of Tesla, it's 745. In the case of Apple, slightly above 150. Now, these are all assumptions. For all you know, we wake up tomorrow and something happened in China, something blew up, and here we go, the market's trading down, and all of this is just scrambled eggs. But absent of that, you have to understand how the market makers and the traders are thinking, the stakeholders, when it comes to quad witching. Anyhow, we're going to move on here to the unusual activities that took place in the options market today. Starting with the ticker NXE. This is for NextGen, perhaps another potential for a meme stock here. It is trading under $10 and they're betting for massive gains to come. Perhaps a squeeze by buying the $7 calls with the expiration date of October 15th, with the expectations that the name will pop higher by more than 19% by then. They paid about 35 cents a piece to enter this trade. All in all, spending about $1 million. What about the trade for the ticker CRK? This is for Comstock Resources, whatever that is. They're betting for a pop here by buying the $10 calls with the expiration date of October 15th, with the expectations that the name will pop higher by more than 9.5% by then. They paid about 50 cents a piece to enter this trade. All in all, spending about $500,000. What about the trade for the ticker KWEB, the KWEB, the Chinese Technology ETF? Lots of pain in Chinese stocks. Whether we're talking about Alibaba, JD, or now even the casinos, Las Vegas Sands, Wynn, Melco, all down big, second day in a row. And it seems like every morning, every day we wake up, we get more negative news from China, cracking down on something. And here we have a trader betting for more pain to come in the KWEB by buying the 41 puts with the expiration date of October 15th, with the expectations that the KWEB will drop by more than 15.5% by then. They paid about 50 cents a piece to enter this trade. All in all, spending about $400,000. Now, what about the trade for the ticker ATNF? This is for 180 Life Sciences, whatever that is. They're betting for a massive pop here by buying the 7.5 calls for the expiration date, October 15th, with the expectations that the name will pop higher by more than 13.5% by then. They paid about 50 cents apiece to enter this trade, all in all, spending about $350,000. Now, there is a trader called 50 Cent, and they usually buy monthly expiration out of the money, costing 50 cents each. So could they be behind the CRK, KWeb, and ATNF trades? Who knows? But what about the ticker XLNX for Xilinx? They're buying the 175 calls with the expiration date of October 15th, with the expectations that the name will pop higher by more than 11% by then. They paid about $1.50 apiece to enter this trade, all in all, spending about $1 million. Lastly, what about the trade for the ticker WYNN, Wynn Resorts? Not winning today, a massive down day, and they're betting for more pain to come. Wow. By buying the 80 puts, the expiration date of September 24th, with expectations that the name will drop an additional 7.5% or more by then, and they paid about 85 cents apiece to enter this trade. All in all, spending about $500,000. Moving on to the heat map analysis. What's going on here? Again, the tide that lifted all boats. Everything lining up green with very few exceptions. These exceptions are TSM, Qualcomm, certain chips names. We have certain news for these names. We have Electronic Arts down, but it popped after hours due to a new release. We have Facebook down just slightly. We talked about the bad news for Facebook yesterday regarding the body image and all of that. And then we have Chinese names, Alibaba, Pinduoduo, JD, all trading down, along with the resorts, the casinos. We talked about that, Las Vegas Sands, Wynn, etc. But we have another name that perhaps caught a triple whammy here. Starbucks, down big today. Number one, we had the IPO of Dutch Bros, which was extremely successful, by the way. And then we had the news from Yum Brands in China, issuing a warning that the Delta variant in China is way worse than we've been told, and it will have a significant impact, a negative one, on the top and bottom lines for Yum China. Now, all of that is happening on top of the news that we get every day, it seems, of Chinese crackdown on companies. And we've been waiting and waiting and waiting and wondering, when will the shoe drop for American brands? Starbucks, Nike, McDonald's, Apple, etc. Because the CCP is not just interested in reforms or regulations. We talk about these societal changes, about men needing to be more masculine, etc., etc. How does Chinese young men wearing Nikes, using Apple phones, and slurping Starbucks fits with the Chinese Communist Party's idea of the Chinese masculine man? It's just a matter of time here, folks, before the massive shoe drops, which nobody's anticipating, by the way. Now, the market opened higher, but it was mixed. The tech names were actually trading down. The market opened favoring the sectors of the market tied to commodities. We're talking about oil. Oil stocks were blasting higher at the beginning of the day, and the reason is we got the inventories and they were way down, and therefore the supply way beyond the demand, and therefore crude oil prices rising higher, energy stocks also popping higher. Likewise, in the morning, when we talk about commodities, your boys' favorite stocks, the likes of FCX, Freeport-McMoRan, were popping higher, along with Alcoa, aluminum, steel stocks, even fertilizer stocks, all popping higher in the morning. This was the consistent theme early on in the morning. Likewise, banks were popping higher, as yields were popping higher in the morning. The technology trade played catch-up from behind. Perhaps the Yom Kippur pump, the tide that lifted all boats. Moving on to charts, starting with the 30 minutes chart of the SPY, the S&P 500. A massive reversal day, the return of buy the dip, perhaps, or is it? Perhaps it is a dead cat bounce. How do you distinguish between the two? Well, if there was a way, I wouldn't be here. I would be in a bunker, busy being the richest man in the world. But all what we can do here is look at the data, the positioning of options, study the psychology and the stakes involved, study the charts, study the seasonality. And this is all what you can do to come up with an educated analysis that will help you trade the market regardless. We will look at the chart, buy the dip, massive pop higher, algorithmically on low volume, closing above 447, the resistance. Is this bullish or is this bearish? The answer is it is bullish. But we have a few problems here. Number one, obstacle number one, is the soft resistance of 448.87, which the chart reacted from multiple times before. Obstacle number two, we have the RSI indicator perhaps getting too extended here. Maybe we'll go all the way in the morning to 448, perhaps 449, and the RSI will become quote-unquote overbought, prompting a pullback. Obstacle number three is our analysis of the options market. The market maker has no incentives at all to close the SPY above 450 by Friday. So my call is it's going to be flat here. Perhaps a pullback, a small one, and the chart closes above 447 for the week, but it's not going to close above 450 for the week. Otherwise, the market maker loses. Moving on to the daily chart of the continuous contract on the SPY. What's going on here? As we expected, a pop, a reaction from the trend line to the penny. The problem is when we talk about a follow-up, a confirmation or not, when you ask me, is this a dead cat bounce or is this a sustainable bounce? Perhaps the answer will be in the confirmation. If the SPY pops higher tomorrow, then we have a confirmation that this was a garden variety pullback to the trend line and the market will continue to grind its way higher. If not, and the momentum indicators perhaps suggesting that it will not be a garden variety pullback because we have weakness. Not a significant one, but still here. When do we get the confirmation that the trend is over and the tides shifted from bullish to bearish in the market? Perhaps breaking the support line, but for me personally, the confirmation will be breaking the support of 4,384.5. Also notice the volume. The volume topped, it's a peak. Now we have Yom Kippur. The volume is down, not a lot of trading, and that paves the way for the algos to do their thing, pumping the market higher with very little resistance. Critical day tomorrow. Either it's going to be confirmation that this is a bottom and the market will continue in its trend higher, or it's going to be a confirmation that the trend is over. Moving on to the Qs, 30 minutes chart. What's going on here? Again, gapping higher, but selling off, sell the rip. But are we back to the buy the dip mentality? You cannot say that. Why? Because the algos did the job. The volume was down. Had we gapped down in the morning, big time, and then the market bought the dip aggressively with higher volume, then I would have been more comfortable in calling the bottom and saying buy the dip is back. But for now, this hyperbolic move, almost a vertical move higher, all the way to the resistance line of 378.45 and stopping right there. This move is algorithmic combined with some short covering, aka taking profits. The chart tells a story. It's Yom Kippur, not a lot of volume. The algos did the job, but it also tells the psychological battle between bulls and bears. The bears remain scarred and scared. They score a little bit for a day or two and they cover right away. Why? The trauma. This market has been traumatizing for bears. So the expectations are until and unless we see massive pain across the board, massive crashes, the FANG names crashing, the bears will not be emboldened to hold their shorts for longer than a few days. Now, what do we do with the chart here? We are facing the resistance at 378.45. The likelihood is that the Nasdaq will pull down, gathering some energy before popping higher above that level. If this is indeed the bottom for now. Now the pullback could happen overnight in the futures and then the Qs opens up gapping higher. For me, that will not be an ideal scenario because if the market gaps higher, this will open the path once again for sell the rip. So again, my expectations are a retreat off the resistance of 378.45 and then a potential for gathering of energy and popping higher, closing above the resistance line. The key here, when that small pullback happened, will the buyers show up, helping the Qs to break above the resistance line, or will they be absent? And if that is the case, then this is a dead cat bounce. The algos do the job for a little while, bouncing the market off the 50 days moving average, but at the end of the day, if the retail traders, if market participants don't do the follow-up, then the market goes back to how it was trading before. Moving on to the daily chart of the Qs, what's going on here? This chart remains more bullish than the SPY, and the reason is the candlestick pattern remains intact. We haven't even gotten down to any trend line whatsoever. The MACD, the RSI, all trading higher. Yes, we have some weakness, some loss of momentum, but the strength remains the story here. Anything to see? Anything to see at all? Not really. From a daily chart, not really. The story is the 30 minutes chart, perhaps even a shorter chart than 30 minutes because we're dealing with the seasonality and the mechanics. What about the IWM? Popping higher, but again, not buying the pop. I told you yesterday, we have oversold conditions in the RSI, prompting a mechanical bounce. But for me, a retest of 218 and then bouncing higher would have been more comfortable. So for now, I'm waiting and waiting and waiting for a confirmation. The confirmation will be the IWM closing the week above 223. Then we'll see the mechanical bounce work, and market participants made the follow-up, buying the IWM, buying the Qs, buying the SPY, and pushing them higher. Absent of that, the potential for a dead cat bounce is highly likely. Dixie, what's going on here? We were expecting a pop higher in the Dixie. It looks like as if the Dixie is working its way, gathering energy, waiting for the catalyst to pop significantly higher. What would the catalyst be? We have to wait for the economic calendar. There are a lot of events, a lot of data about to come out that could move the dollar decisively higher or lower. We have to look at the support and resistance lines for now. The support at 92, the resistance at 93. It would be more significant if the dollar breaks the support of 92, because if that happens, we know right away commodities will shoot up higher, meaning you have to buy energy stocks, copper, materials, fertilizers, etc. But if the dollar pops higher above 93, commodities will still do fine because all in all, the dollar is down. The problem happens when we see massive pops, parabolic pops in the US dollar. This causes the algos to freak out, prompting a sell-off in commodities, dollar-sensitive sectors of the market, the likes of energy and materials. Speaking of, what about gold? What's going on here? Gold is down. Not a good day for gold, even though the dollar is down. Why? Because the yields are higher. Again, investing in gold these days, not a good idea. You have a lot of enemies in the dollar, yields, cryptos. My advice is either you own physical gold or stay away from it right now until tapering happens or doesn't happen for certainty. And then gold will be investable once again. What about yields? What's going on here? The assumption is that 1.28% is solid floor here. It's a good support and it shouldn't be broken. Breaking 1.28 will be a massive problem. But so far, a lot of stuff been thrown at yields. A lot of bad news. And yields continue to hold 1.28% as support. My assumption is the support will hold until the next catalyst to pop yields higher. What about the TLT? What's going on here? Weekly chart trading above 149. But again, we've been waiting and waiting and waiting for weeks and weeks and weeks for the resolution in this conflict. And it's not going to happen so long as the Fed remains extremely vague. But once clarity arrives, we're going to see a massive, decisive, and extremely volatile move in the bond market one way or the other. If you're holding the TLT for now, you shouldn't worry at all until and unless the TLT closes below 149 decisively for the week, not just hugging the line. We're talking a flush down, closing at 147, 145. Then you got a confirmation it's over, cut the trade, and move on. What about the VIX 4 hours chart? And this remains the most accurate indicator in the market. Watch the MACD. The moment we crossed creating red impressions in the histogram, the pop in the VIX was over. The resistance of 21 for now, keyword for now. The real battle is the weekly closing. Another week closing above 20, we got a problem in the market here. But for now, this is an accurate indicator. The moment you saw the crossing in the 4 hours chart on the MACD of the VIX, you know right away that the pop is over, which means that we have a bottom, at least for now, in the SPY. What about Apple? 30 minutes chart, rebounding higher along with the rest of the market, but the weakness continues here in Apple. There was a lack of conviction in the bounce, a lack of volume, and it seems to be that the bounces are being played via call options, not buying the stock, which tells me that there is a lack of conviction here in buying the dip for Apple. We have soft support at 147, and Apple managed to bounce from 147 higher. The resistance remains 150, but I would be more comfortable if Apple goes down all the way to 145 and then bounces higher with elevated volume. Then I will be comfortable in calling a bottom. They're gonna try, keyword try, to close this at 150 and change, because this is the maximum pain spot for quad witching Friday. Moving on to Tesla, the souffle. What's going on here? It appears as if the souffle is bouncing higher from 742 and making a higher high, which is confusing for now because we have a series of higher highs and higher lows, which was broken by a lower high and a lower low. And just as in Apple, they're not buying the stock here. Nobody's buying the stock here. They're buying call options, pushing these gamma squeezes higher. And the premiums for Tesla options are extremely cheap right now, historically speaking. And that opens the door for pumps and dumps. The assumption here is that we have yet another pump on Monday, Tuesday, and then we will see that fade out heading into the end of the week. But remember, we have quad witching. How would that change our expectations? We talked about that. We have the 745 as the maximum pain point. Moving on to BTC, tulips. What's going on here? Riding higher, but we still have lack of conviction in BTC, meaning retail is not buying. The whales are buying, but can whales maintain BTC higher without participation from the retail side? On top of that, we have Ray Dalio, for example, who came out in the morning today and said that the government will crush BTC Bitcoin if it becomes a threat. Now we have Gensler out of the SEC speaking with both sides of the mouth, sometimes negatively when it comes to cryptos and sometimes positively. And nobody knows what this guy wants to do. For all we know, he's just going to bark and then go back to sleep again. But for now, the crypto market is rejoicing that Gary Gensler did not come out too hawkish against cryptos. But that could change any time once the regulations actually hit. Moving on to AMC, perhaps one of the most important charts of the day. We have a bounce higher. It appears to be a rebound candle, a reversal candle. But look at the MACD indicator, the momentum, from a daily perspective. It's about to turn negative, which is once again leaves the battle. Was this a dead cat bounce, or was this the reversal and the start of a pop higher once again in AMC? I hate to bore you, but you gotta wait for the confirmation. Now, I have little reason to doubt the accuracy of the MACD indicator, but let's play this game. Let's zoom in and study the pattern from today, because it didn't happen just in AMC. It happened across the market. We have a flush down, a sell-off for a few days. Then we have a rebound. I'm illustrating for you in the drawing there. We have a sell-off, then we have a dip buying, a rebound, and then profit taking by the end of the day. What happens next? In the case of AMC, at least from the past 3 times, AMC popped higher. And you can look at it in 2 ways here. Number one, you can look at this as a bottoming formation of a bull flag pattern. We have a reversal. We have a dip buying opportunity, that we have some profit taking, and the chart waits and waits and waits. Do we have other buyers who want to hop on the ride and buy the dip? And the likelihood is, if there are buyers, then the bull flag will play out and we will see AMC popping higher. Or whatever chart it is. It doesn't matter if it is AMC or any other chart. We're studying the pattern. Another way to look at it, the bearish way, that this is an ABC pattern. You have a flush down, the A leg. You have a reaction, a bounce. This is the B leg. And then we have a follow-up to the A leg. This is the C leg, and we see another flush down, breaking the next support level of 42.5. And again, you can go back and study the options grid, the open interest, and come out with a guess, perhaps an educated guess on whether the breakout will come out higher or to the downside. Yet at the end of the day, disciplined traders wait for confirmations. There is always going to be more meat in the bone for you to chew on, whether the move is higher or lower. But if you jump the gun ahead of time and you're wrong, now you're suffering losses. So what do you have to lose waiting for confirmation? Moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? We have a big one, the per usual jobless claims for the week. The expectations are 318,000. But what if the number comes below 300,000? That will be a game changer. But if we get 314, 320, 330, these numbers are not going to be a game changer, which will move the market one way or the other. Then we have retail sales, and this will be critically important. Why? Because we have conflicting information. Number one, we have retail sales from China, a disappointing number overnight, a massive miss, by the way. Now, we know what's going on with China. They have a massive delta problem, even though they're not saying so. But the numbers don't lie, and they have a harsh approach toward COVID. No tolerance at all. Lockdowns all over the place, and therefore, perhaps this was a contributor to the massive miss in retail sales. Now, on the other hand, here in the US, we have credit card companies, the likes of MasterCard, projecting the holiday season to be extremely awesome. Surprise, surprise. But will it be really? This number we're about to get tomorrow will be a leading indicator to the holidays season. Lastly, we have the Fed Manufacturing Index, and this will be on top of the Empire State Index that we got today. Anyhow, folks, this is all I got for you for now, but I will talk to you again tomorrow. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.